Welcome to Kaplan Professional's monthly economic update. I'm Andrew Stark, and today we're speaking with David Bassanese, Chief Economist at BetaShares, about the budget, Australia's major banks, and the future prospect for the US tech giants. David, welcome.
No worries, good to be with you.
The 2018 federal budget has been described as a typical pre-election budget with plenty of winners and not many losers. What did you make of it?
Look, I thought it was a pretty fair compromise in terms of how to spend the budget windfall they get. I mean, the big news was that revenue has turned out better than expected over the last year or so. Better commodity prices, very strong employment growth. And they've basically spent half that windfall through tax cuts and the other half to bring the budget into surplus a little bit earlier. So, a reasonable compromise. For a pre-election budget, they could have spent a lot more. Or for those that wanted them to be, super responsible, they could have, banked a lot more. So I think the compromise is reasonable, and actually giving some support to consumer spending at the moment, which is the sort of, the weak part of the economy through tax cuts, is probably not a bad thing to do either.
Many forecasts for the Australian economy in 2018 are cautiously optimistic, driven largely by improving global conditions, but tempered by uncertainty around household consumption. What do you see as the key themes this year?
Exactly, that is the big tension. And if you look at the economy, business sentiment is quite high. Business investment is recovering, so we've got non-mining investment picking up. We've got mining investment bottoming out. Consumer spending has been okay, but not fantastic. Now, the challenge for consumer spending in the coming year will be that employment growth looks like it's slowing, so that contribution to income is going to die down. But the official forecasters at least have still got quite solid growth in consumer spending. In fact, growth near 2.75%, 3%, and I see that is the risk that consumer spending may actually be a bit softer than that. And so the forecasts, certainly from both the Reserve Bank and Treasury at the moment, of 3 to 3.25% growth, probably the risk is on the downside, I think, to those forecasts.
What are the main international factors and indicators you will be watching closely over the remainder of 2018?
Yeah, look, I think the single greatest factor to watch out for is the US labour market, and particularly any pickup in wages growth. So, we've got the US now with the unemployment rate of 3.9%, close to most estimates of full employment. And basically the risk is that if the wages growth do start to accelerate, the inflation story will become not as favourable. The Fed could get more aggressive in raising interest rates, and that will bring on the downturn in markets. But if wages growth remains moderate, the US economy can continue growing quite well, and interest rates in the US not rise aggressively, and that's quite bullish. So that is, I think, a key swing variable for the markets and global economy over the coming year. Other issues are in China, for example, the transition, the extent to which they can cut back their still overcapacity in steel consumption, steel production, I should say. They're talking about scaling back loss-making steel producers, which could have a negative impact on iron ore prices. It's another issue to watch. Obviously, Donald Trump and the political fights that he's having around the world is another thing to watch. At the moment, the markets are basically saying his bark is worse than his bite. He talks, he makes a lot of threats, but doesn't necessarily go through with a lot of those. He has recently now announced that he will pull out of the Iran deal, so that is some signs of action. But again, that's going to be a lingering source of concern, I think, and uncertainty for markets.
David, thanks for your time today.
No worries, thank you.